Hello, this is Andrew Pang. Thanks for tuning in to today's edition of CMS Forex News. It is Friday, December 5th, 2008. We begin with fundamental data today. In Germany, factory orders plunged 17.3% on the year in October and were down 6.1% on the month. Both figures were below economists' forecast and illustrate the difficulty the Eurozone's largest economy is facing following the intensification of the credit crisis. In September, monthly orders fell at the fastest pace in 18 years. In the U.S., the monthly non-farm jobs report was very grim. November saw the economy shedding 533,000 jobs, the sharpest in 34 years, and October's figure revised down by 80,000. The decline was worse than anticipated and signals that the U.S. recession is deepening and may be more severe than the last two we had in the early 1990s and in 2001. The unemployment rate increased to 6.7%, a 15-year high. The report will put pressure on the Fed when it meets on December 16th. Rates are already at 1%, and expectations will be for another 50 basis point cut, though the Fed may deem it necessary to cut rates even further, bringing the U.S. close to a zero interest rate policy. The euro-dollar pair fell overnight as European stocks were lowered and the Germany factory orders pressured the euro. Following the U.S. non-farm data, the pair saw some back-and-forth action with the pair keeping most of its overnight losses. This cut into yesterday's sharp euro rally following the interest rate cut from the ECB. The dollar's gains reflect increased risk aversion, which has been boosting the dollar during this financial crisis. The dollar-yen pair had a more straightforward reaction, falling below yesterday's low near 92 to test the area near 91.60, a move of about 100 pips from its session high. U.S. stocks fell at the open and the Dow Jones Index was down more than 200 points in early morning trading. The yen is the other currency that has been gaining during times of risk aversion. The sense of risk aversion pushed the pound-dollar pair lower as well, continuing a downward channel that we have seen this week. The pair came up to its line of resistance near 1.47 and was turned back following the non-farm release. The Canadian economy, meanwhile, shed 70,600 jobs in November, almost 3 times the number of lost jobs predicted by economists. Losses were split pretty evenly between full and part-time work, though Ontario's manufacturing sector led the overall decline. The unemployment rate inched up to 6.3%. The U.S. dollar-Canadian dollar pair was climbing in favor of the greenback prior to the release and continued surging afterwards. The 220 pip rally brought the pair to 1.30, a key level of resistance that has stopped the previous 2 greenback rallies in late October and late November. The loonie is feeling the pressure as the country's political scene is mired in uncertainty and oil prices continue to decline. For the week, the greenback is up nearly 600 pips. Next week starts with producer prices from the UK and industrial production data from Germany. On Tuesday, the UK will post its manufacturing data, the Eurozone releases measures of investor confidence, and the Bank of Canada will decide on interest rates. And that wraps it up for the week in Forex News. Please join us again next week right here at cmsfx.com. Until next time, happy trading.